Friends, it is indeed a privilege and an honor for me as a pastor of this ministry to have this opportunity to be here and to share with you again part 3 of a very necessary discussion between the church and the bank. You know, one of the things that's very important about this discussion is we're probably two of the most admired to some degree, and then some of the most feared institutions when it comes down to finances. And so I'm indeed privileged and honored to have this opportunity to discuss these topics with my great friend, Matt Breeden. He is the president of First Citizens Bank here in North Augusta. And I tell you, if you need a friend, a friendly banker, if you need to befriend an institution that literally does care about how you function in the bank and how well your money performs for you, Matt is certainly the person to call on. Praise the Lord.
Appreciate it.
Yes, Matt, I'm honored that you're here with me today.
Well, it's always a privilege to be here. I've very much enjoyed getting to have these talks with you, and hopefully some of the information and some of the topics we talked about, hopefully they've been impactful and positive for some of those within the church. So,
well, the first 2 discussions have been tremendous enlightenment, I'll call it, and a lot of us here are still just kind of chopping at the bits, and we're constantly sharing that information because some people use it over and over kind of religiously to address their situations. And I think you've seen some, and then some are still trying to find a place in their schedule so that they can come and sit down and talk with you.
Sure.
Matt, one of the things that's transpired since the last time you and I had a chance to discuss these topics is that several of the banks have actually collapsed, shut down, failed. Can you help us understand from that perspective, from your perspective, what it is then that should be happening with those of us who are trying hard to work with the bank, but then maybe not certain all of a sudden because of the things that's transpiring?
Well, I think everything you're seeing on the news and on TV is, anytime you're dealing with the safety and security of your money, it's incredibly important. And I know that a lot of the information that's out there, most recently with the 2 failed banks, has been could have been very concerning for anyone, because most people have, whether they use a regular bank or they have some type of financial relationship with some company, and the thought that company could fail and therefore cut them off from access to their funds can be a very scary thing. And so with what we've seen, the first thing I want to say is, and this is my personal belief, any of your banks that you're around, here around town in the area are what we call retail banks. Those are branches that you can walk into, you can talk to a banker, you can see a teller. Those are your First Citizens, your Wells Fargo, your Security Federal. There's all those kinds of banks. I personally have zero concern that similar things are going to happen to any of those that we're all familiar with.
Okay.
And to share a little bit about why, some of the biggest factors that led to the 2 recent failures of, including Silicon Valley Bank, was something that most folks might not realize. So whenever you have your money on deposit at a bank, let's just use a number like $50 million. Let's say the bank has $50 million on deposit.
Okay.
Unfortunately, that does not mean that at any given time, all of their customers can walk in and withdraw $50 million. Because the way a bank is going to make money is by taking in deposits and then loaning that money out, and also making their own investments. So whereas on the books, the bank may have $50 million in deposits, a lot of that $50 million is tied up in loans that have been extended to other customers. It could be tied up in other investments that the bank has, and that's totally normal. But what happened in these situations was they both experienced what we call a run on deposits. And
a run on
deposits.
Okay.
And so the bank has to balance, okay, we've got this amount of money on the books for deposits. So we've got to make sure we kind of forecast, we've got, enough to sustain normal day-to-day transactions. So people are going to need access to their money. We've got to balance that with being able to loan that money out and make a profit so that we can keep the doors open. And what happened with these two is, I can't really speak to exactly what happened as far as why, but the depositors, when I say a run on of deposits, that means that a large amount of their customers all at once came to the bank and wanted to withdraw large sums of money. And in a situation like Silicon Valley Bank, that was especially hard because they have a much narrower, smaller client base than most of your retail banks like you're familiar with here. A lot of their customers were big tech companies that had millions and millions and millions of dollars, and so a few of those coming in and withdrawing was a huge hit, and they just didn't have the deposits on hand to cover that kind of a scenario. Whereas what makes me feel so confident about it, your traditional banks around, like we're all familiar with, is we are less, we all love a big depositor. We want, love a client that's going to have a lot of money.
Right.
But the difference is you're much more stable when that money that you have on deposit is spread out amongst a larger number of people. So if it's only spread out between a few and those few decide to come in and pull it, you've got a mess. Whereas if it's spread out among tens of thousands or hundreds of thousands of customers, a few people are going to move their money. It's going to happen, but it's not going to create the same sense of panic that we saw with those banks.
And so when that panic starts, how does it impact a bank like First Citizens Bank?
So the first thing, at least I would say, is that, even if our customers don't have any relationship with any of those banks, the fact that a bank could fail is a scary thing. And so I think the first instinctive reaction is my bank safe? If I bank at First Citizens, is First Citizens safe? Is my money safe? So that's really, as far as our customers go, what to me is probably the immediate reaction.
So Matt, how does the FDIC factor into your bank, your institution, as opposed to what happened in Silicon Valley?
So I'm going to speak to very high level because I'm not, I don't know all the ins and outs of the FDIC. FDIC, basically they're there to regulate the banking system to make sure banks are stable so that hopefully things like a bank failing don't happen. But they are who will go in, and if a bank fails, they're going to make the decision to shut them down. And so the relationship between the FDIC and, let's just say, First Citizens, a lot of it has to do, the way I look at it is each bank can have a certain reputation with FDIC, which you want that to be a good reputation. And this isn't just my opinion. This is coming from a lot of different measurements that are out there that are done by analysts that rate the strength of certain banks. And, First Citizens is historically, for 125 years, been around, and they have a very strong reputation with the FDIC. They're known for being a strong bank. So
125 years.
125 years, yeah. Yep.
So then you're saying then that what happened in Silicon Valley, and then our relationship with First Citizens, even though it may signal the type of panic that makes us more intense in doing our research, doing our diligence to make sure that our money is secure, but there's really no real reason to fear.
My personal opinion is no.
Opinion.
Yeah. I told somebody this morning, I said, trust me, if I believed that we were in a banking situation where the bank was going to fail, my livelihood's dependent on that bank.
Okay.
So
you're vested in it
I'm
as well as everyone else.
I'm vested in it as well. So.
One of the things I teach about faith and finances, and really getting people to understand that the difference in the bank and God is that God's system or his economy, if we do it right, never fails. In fact, the Bible says the word can't fail, cannot lie, shall not return void, but always accomplishes what he sent it for. Sometimes what we see is historically institutions banking institutions have failed, and they were to some degree responsible for a tremendous societal crisis, depressions, the age of depression. And so you think a lot has been done since that to sort of give us safeguards. And
Yeah, so over the years, there the bank regulations, which are a lot of what goes into specific things that banks have to do to make sure and to prove to the FDIC and to the federal government that they are safe and stable. A lot of those regulations have been tightened up over the years. So banks go through things like regular audits. The larger the bank, the more stringent those are. Typically, the more thorough the audits are, the more that the higher level of just details that go into assessing the bank's strength.
one of the questions that we've gotten, thank you so much, Matt. One of the questions that we've gotten more consistent than some others that I'll ask has been people trying to sort out the difference in what institution you would suggest would probably be more advantageous for their investments in this season between investment brokerage firms and the bank. Can you speak to that?
Yeah, so there, I believe what you're referring to is there are, that are strictly investment firms out there,
Yes.
like ones you're familiar with, Edward Jones and,
Yes.
Things like that. And then, and a lot of people don't even realize this, but banks, we have the same thing. It's just under the umbrella of the bank.
So you have the same thing as Edward Jones.
We have the same thing. So if you go to an Edward Jones or one of those firms, you're going to speak with a financial advisor. So they're going to be somebody that's, been trained and has the certifications to discuss certain types of products, insurance, investments, things like that. And through most banks, I can't speak to every bank, but most banks are going to have a similar thing just within the umbrella of the bank. So, for example, if you were to come to First Citizens and want to, let's just say you retired or you're about to retire and you're kind of not sure how to handle that, we have certified financial planners just the same as an Edward Jones or one of those companies that you can actually sit down with in the familiar setting of your bank. Because typically you're going to do more interaction with a bank than in an investment firm because you're doing normal day-to-day banking and transactions. But yes, I definitely, most of your regular banks are going to have the same type of advisor.
Okay. It's amazing how sometimes when you're dealing with an investment brokerage firm, they literally sound almost as if that's non-existent in the bank, even though you're part of the bank, and they probably are also.
Yeah, and I'll tell you one reason that I'm a fan of taking advantage of the advisor opportunities within your bank versus going out to just a strictly investment firm. And it's because, and again, a lot of this depends on the people you're working with and how they do business. But for example, what we do is, if I go to an Edward Jones, a lot of those are just going to make their decisions and their recommendations based on limited information. Whereas if you go to, for example, a First Citizens advisor, they're going to have the same information that an Edward Jones would have, but they're also going to have the information of your banking relationship, which doesn't necessarily mean your checking account. But if I'm going to come to you and recommend you take this amount of money and invest it or do something specific with it, a very important factor that I think needs to be included is if let's just say you own your home and you have a mortgage or you have a lot of credit card debt or something like that, all of that would hopefully go into the recommendation versus just strictly, hey, I've got this money and I want to make more money with it. Because you may come to me and want to invest, $50,000, and if I don't know you've got $50,000 in credit card debt, I'm going to take your $50,000, we're going to invest it and go about our merry way. But if you were to come to the bank, they're more in tune to a more holistic approach. And so they're going to uncover through conversation, because we're going to want to know everything about you. And it's not because we're nosy, but
Right.
it's because
It's necessary.
if I'm going to tell you what to do with your money, I need to be informed about your life, your finances, and what's important to you. And so there's a very strong chance that I might say, I don't want you to invest this $50,000. I want you to take it and pay off these credit cards, because long term, that's what's going to improve your life the most and put you in the best position moving forward.
That sounds almost like one of the sessions, the consultation sessions I did not long ago. I had to say to the individual that some of the questions I'm about to prompt you to answer are going to sound as if I'm being rather nosy, but these are not nosy questions, they're necessary questions. So you're telling me that what the bank does is a very thorough, investigative type of research in order to engage a holistic approach based upon the history of the individual and their functionality within the...
Correct.
Okay.
Yep. Because there are, and I may go into, let's just say I go into a mechanic shop because my car's making a noise and I don't know anything about cars. But let's say I think this is my transmission, it's making this noise, I need a new transmission. The transmission may not be the problem.
Wow.
But I've walked in and I've said, it's making this noise, and I know it's the transmission, I want a transmission. And they can replace your transmission, but they haven't fixed the problem. And it's the same thing at the bank. We will often have someone walk in and I want this or I need to do this. Okay, that might be the case, but just to make sure that that is the best way to go, I want to ask you some more questions, because I want to have a big picture of what it looks like and where you're trying to go.
See, that reminds me of a time that I visited you and I was trying to adjust my own portfolio, but I needed some real insight. I was thinking, traditional understanding is pay off the credit cards or get the debt down to the ratio down to below 30% and manage it there, regardless of how many cards you got or whatever, and try to make sure that they exist at least somewhere between 30 to 10%, et cetera. And I think I had, there was one in particular I've been using, and every time I would get it to a certain point, then something happened again. I went in, we sit down and we talked about it. And in the process of doing so, I think you asked me two questions. What was it? One of them was, what did I want to do? What was my goal? What was it that I was really trying to target or accomplish? That was very defining moment for me, because my traditional understanding was before you, and I want you to kind of speak to that to some degree, was that, okay, always pay down the small ones first, right, even to the point of paying them off, and then graduate, progress up, and then tackle the large ones as you go, right? But then what was it you said to me, if you can remember back then, that really, I'm sure if you were watching me, my countenance probably changed, because it was almost as if it was, wait a minute, this is a revelation. But I will say this, as a spiritual man, one of the things that caused me to actually set up the appointment back then was I was praying, and the Spirit of God literally, I believe, said to me, you need some advice. And I do not pretend to be a financial expert. Now, I don't pretend, but I really consider myself one that's astute in the scripture because of my personal relationship with God, the time I've spent in it, all of that, etc. But I know the decision I was about to make needed to be, I needed some counsel. I needed to consult with someone. And I'm thinking that morning, with good advice make war, and a multitude of counsel there is safety. Where no counsel is, there people fall. And I'm hearing it like a heartbeat. I pick up the phone, text, call, and you say to me, come on in, whatever. And we get in and we start talking, and there it is.
Yep.
I discover that, wait a minute, the traditional understanding would not work in my situation.
Well, I think that's a good example. So, this is not me speaking to your specifics, but let's just take a person and hypothetically that has if we're talking about credit cards, let's just say hypothetically this person has $20,000 in credit cards and they've got 10 cards. They want it to go away, right? That's the same. That there's no debating on that. But how you approach that depends on not just wanting to get rid of it, but are there any other goals that are also trying to be accomplished? And so let's say you're taking two people, same amount of credit card debt, same number of cards. The path that I would recommend can be very different between the two. Like I know you mentioned earlier, the traditional, and this is the most common, is okay, if you've got 10 cards and you owe $20,000, start with the smallest one, pay it off, then move on to the next one, pay it off. And that's not a bad path. But let's throw one other factor in there.
Right.
Let's just say, well, I'm trying to get rid of it, but I'm also trying to, as quickly as possible, impact my credit score. And so in that kind of a situation, again, depending on details and all that, but my advice would quite possibly be different in that, let's say one of those cards of your $20,000 was a $14,000 limit and it was maxed out. Whereas you may have a couple of the smaller ones that are a few $100, $1,000. I wouldn't tell you to start with those. I would tell you as quickly as you can get that big one paid off, the better, because that's the one that even if the other ones go away, your utilization is so high.
That's the one
on
impacted.
that one.
Okay.
So putting that extra factor in there of trying to improve the credit score at the same time, that's an example where having a good understanding of what's going on and what we're trying to accomplish can usually change the advice.
So far you're saying then that if my goal is to impact my credit score, that's going to determine which route I take.
It could, yes.
It could,
yes.
okay. And in many cases, the one that's speaking directly to those numbers is the one that has already reached its ceiling.
Correct, yes.
Okay. Now, in another scenario, if the goal is to just say, for instance, get yourself in position to do some type of consolidation or to situate your money so that you don't have to use so much of your own personal money, but where do we go then?
Yeah, so debt consolidation loans are very popular. They're very, common that you hear about them. Sometimes those can be a good thing, not always. And so an example would be, if you're going to do something like that, it could be for many reasons. Again, this is another example where, all right, well, what are you trying to accomplish? Are you totally comfortable with whatever you're paying each month and you just want to pay less interest? Or have you had an impact to your cash flow and you need a lower payment so that you can still maintain your other bills?
Very good.
So in that situation, the interest rate might not be the most important thing, because you may have had a crisis in your life that has occupied a lot of your money and you just need the relief of a lower payment. And so a debt consolidation loan, it's important to know, all right, well, what am I trying to accomplish and does this fit it? So a lot of the debt consolidation loans, I've started seeing more on TV commercials advertising these. And if you look in the fine print, the interest rate on some of these is astronomical. Sometimes it's higher than a credit card rate. Yes. And so if you're trying to get if you need to get the payment down and that's going to do it, they might be a good option. But if you're trying to save money in the long run, pay less interest, you might actually you might have one payment instead of 6, but you may end up paying more over time than if you'd have just left it alone.
Still end up paying more over time.
Yeah.
Wow. So that immediate relief may not be well over a span of time.
Right.
Okay, beautiful. So let's kind of shift a little bit and talk a little bit about small business startups.
Sure.
What kind of products does your bank have in place for small business line startup?
So this is probably my favorite topic to talk about.
Really?
Yeah. So,
wow.
It really depends on the situation. So anybody that started a business and has gone to any bank and wanted to borrow money, they may have been able to do so, but they may have been told, well, we can't help you because you haven't been in business for 2 years. and we can't loan you any money until you've been in business for 2 years.
Okay.
So as far as what we do loaning money to a startup. If you think about it, if the bank's going to loan you money, they're going to want to have assurance that it's going to get paid back, right? And so if the business is brand new, doesn't even exist yet, and that's what you're going to be needing to pay the money back, there's no track record. So it may sound like a great idea, it may be a really great idea, and you might be on the verge of exploding into a multi-million-dollar company. But in order for the bank to loan you the money, they've got to have something to show, well, this money's going to be coming in from somewhere, and they're going to pay it back. So as far as what we have, our options are typically going to be better suited for someone who is, they're starting a business, but they also have a full-time job or, other income coming from somewhere, to where if, let's just say, the business doesn't make any money right away, they can still make their loan payment.
They can cover it.
They've got other means to pay it.
Okay.
Whereas someone who has no other income source and is strictly going to rely on that new business, that new company, there's no track record, there's no guaranteed money coming in. So for someone who has other means, other income, we have different options as far as, it really depends on the type of business you're starting, but some of the common ones that I've worked with the last 6 months or so have been, there's been a big boom in trucking, not just 18-wheelers, but delivery. We have the new Amazon plant, and there's a big demand for people that can drive trucks, and so you got to buy the truck. So we've been able to help clients with that.
Listen.
So
I mean, actually, again, that's one of the real pivots of this discussion. I want my people to be owners.
Mm-hmm.
I want them to understand the importance of ownership, but also partnership for ownership, so that it's not so much immediate demand
Mm-hmm.
on them, and they have, some kind of economic leverage, so they can kind of spread themselves out and deal with the specifics without overextending themselves. Because sometimes the psychological part of this is the reason why we meet early failure,
Mm-hmm.
not having, these other kind of relationships, networking in our favor.
Yeah, and you need somebody that when you're sitting down and you're, made the decision to leap into something as serious as starting a business, it's important to get input and counseling and guidance from others, because it's easy to get tunnel vision. If someone's made the decision to start a business, it's likely because they're super excited about whatever this business is, and they think it's going to be amazing, and hopefully it will be. But sometimes that can give us tunnel vision, and we may be so focused on that dream that doesn't yet exist that we may overlook simple things that, maybe I need to think about doing this before I start this business. Maybe I need to get this paid off before I start this business. Maybe I need to look into how much other things are going to cost. Because if I told you I wanted to drive a truck and deliver packages, I've got to buy a truck, but I've also got to buy insurance on that truck. I've got to pay property taxes on that truck. There's a million other things that'll go into that you have to think about.
So it sounds like passion without meditation can result in tunnel vision without legitimization.
If you just came up with that was awesome. Because yes,
Really?
Yes.
I just heard it. Passion without meditation can result in tunnel vision without legitimization.
Mm-hmm.
And I guess that's what you see a lot of times. You see, because passion is deceptive without meditation, you can actually be in a position where you're too passionate to see clearly. Mm-hmm. And all you see because of your passion is an end that may never materialize if you don't meditate and look at all of the nuances associated with trying to get startup and maintenance.
And I don't want to seem like I'm taking away from that dream
Yes.
or that passion, because I'm somebody that truly believes that there are things that we are shown, that we see, that is a sign of where we need to go. And not everybody sees that, but we might have seen it. And so that passion and that drive is incredibly important. And you shouldn't let the the fear of the little other things that could happen deter from it. Now, they're important to make sure you do that, achieve that dream effectively and start that business effectively, but don't let that scare you away from it. If you feel like you were meant to do something, don't not do it because you're scared.
Right.
But be thoughtful about it as you're preparing.
Well, the Bible tells us, count up the cost. It was said like that. Count up the cost. Don't stop. Don't not do it, but count up the cost. Really just consider all of the things that's associated with it as best you can. I like the idea of getting as much advice as I possibly can. I do have some friends that have been very successful, and they were successful at succeeding and successful at failing. I have one friend in particular who failed 4 times, but he succeeded 5 times. He's been a millionaire 3 times out of the 5. And so he's been able to accomplish. I asked him, I said, well, somewhere between the first and second failure, did you just get discouraged? He said, no. I said, why? He said, because I had learned how to. I said, how to do what? Fail in succeeding or fail in fail? He said, well, it was my relationships that was brokering my failure. But it was my professionalism that broke it. You see that? My economy. I said, well, they're both economies. They're both dependent upon how you exchange. He said, well, yeah, one begets children, the other begets finances. So because I did not know how to do relationship finance, I did not forget how to acquire monies. And so I wasn't afraid, because what I had done before, I never lost the ability to do again. And he said it was quite easy for me to become a millionaire the second time. And then the third time, I had absolutely no fear at all.
Yep. If you look, you're going to make mistakes. You're going to fall on your face. You're going to fail. And I don't believe in letting that determine where you go next. Don't let that determine it. Learn from it. So learn from your mistakes and what you could have done better. If you went broke on this idea, then figure out what you could have done differently and put all that towards the next one. But focus on moving forward. Don't focus on what's behind you, where you failed. Focus on where you're going and use what's behind you to get to where you want to go next. That's what I hear.
I love it. Well, now let's look at this for a moment. We got just maybe, I'll tell you what, let's do this. Let's take a break, and then we will come back and I'll finish asking a few more questions, and then I can let you go.
Sounds good.
All right. Thank you.